are you? Sorry I'm late. My train was delayed.
No problem. Don't worry. We can start now. Yeah, it's all right. Yes.
Okay.
Okay. Right. So shall we start? I'm recording the lesson today also.
Yeah.
Right. So remember last time we started with the taxation. So we were on the tax losses. But before I move further, I want to look at a couple of numbers, few questions, just to get a hold of what we have done last week, Jenny.
Okay.
So what I want is just take a piece of paper. Take these numbers and we will try to work it together, whatever the figures that we need to do, the typical questions that can come up in your paper.
Okay.
To put some few numbers, so let's assume that a particular company called APLC,
Yeah.
they have made an accounting profit of 80,000. So that is what we call profit before taxes. They have made accounting profit of 80,000 for the year ended 31/3, say let's assume 2016.
Yeah.
They made accounting profit of 80,000 and profit includes 5,500 of entertainment. In arriving at this profit, they have charged 5,500.
Yeah.
Entertainment, which is disallowed expenditure.
Yeah.
Right? And also 8,000 of income exempt from taxation. So in this 80,000, there is an income of 8,000 which is exempted from taxation. In other words, you don't need to pay tax on that 8,000. So our question what we are given is they said the tax rate is 25% of this company or for this company.
The phone, it's not very clear. Could you say that again about the 25%? I didn't hear that.
The tax rate is 25%. The company has to pay tax 25% on what we call taxable profits.
Yep. Mm-hmm.
Right? So the question is, we have been asked to calculate the tax that has to be paid by APLC for the year ended 31/3/2016. So that is the question. So we start off with our accounting profit. So that is our starting point. We say our accounting profit is 80,000.
Yeah.
80,000. And any disallowed expenditure, we must add it. So there's a 5,500 disallowed expenditure that must be added. Any exempted income should be deducted because we don't need to pay taxes.
Yeah.
That 80,000 includes exempted income of 8,000. So deduct it. So 80,000 plus 5,500 minus 8,000 is what we call taxable profit.
Yeah.
So this is what we call taxable profit. And on the taxable profit, 25% is your tax. So on the 77,500, 25%.
Yeah.
Is the tax what you have to pay, which comes to 19,375.
Yeah.
So that's all you have
That's
to do.
what I got.
Yes, that's all you have to do it. Right? So what I'm going to do is, as we start, we will look at a few questions just to pick up something what we have done last time.
Okay. Is this one more practical heavy, this exam, or is it even split between the theory and the calculations?
As I said on that on the tax part, it will be about 75% theory, 25% questions.
Okay.
Yeah, out of the 60 questions, you may have about 25% of questions on taxation, about 15 questions or maybe 12 questions. Out of 12 questions, maybe about 7 or 8 on theory and 3 or 4 on the calculations.
Okay.
Just to give an idea, now let's move into the last slide. We were on the subject of tax losses. How we can set off the tax losses. So as I said, there are many ways. One way we can carry forward for the next years. The next one is we can carry back for the previous years, or sometimes we can offset against the company profits, or sometimes we can offset against capital gains of the same period. So these are few areas the way that we can claim the taxes, the tax losses. So here again, if I can, yes, let me look at a question before I move forward to see whether we really understand how the tax losses can be worked through. So let me see where I can here. So here we have a particular trader, and in year 1, so I'm going to put some figures. Year 1, he has a profit of 20,000. Year 2, he has ended up with a 45,000 loss. Year 3, he has ended up with a profit of 19,000. Year 4, he has ended up with a profit of 25,000. So within the 4 years, there is 1 year we have a loss, and in this country, in this particular area, what they can do is any tax losses they can carry forward to be set off against the future profits. So I told you some countries they allow you to carry back, in some countries they allow you to carry forward. So the question is, what are the taxable profits of each year in this company? So let's look at the year number 1. In year number 1, they have a profit of 20,000, and that will be the profit for year number 1. Because there is no carry forward losses, earlier losses that is coming up. So year 1, the loss will be, the profit will be straight away, the year 1, what they say is a trading loss in any year can be carried back. Oh no, sorry, I made a mistake. A trading loss, a trading loss in any year can be carried back and set off against the profits of the previous year, and any unrelieved losses can be carried forward to be set off against the profit in the future years. So in this particular case, you can work both ways.
Okay.
Right. So now that is interesting. So year 1 we have made a profit of 20. Year 2 we have made a loss of 45. So the moment we make a loss of 45, in that year tax is 0 straight away. Right? Yeah. In that year. But that 45,000, first of all, we can carry back. So we can go to the year 1, we can set off out of 45,000, since there is 20,000 profit, we can set off 20,000. You can't set off anything more than 20,000. So we can set off 20,000. So 20,000 is the profit available. Out of 45,000, 20,000 can be set off. So here 1 also will be 0 tax. Okay?
Yeah.
Then we have a 25,000 which we can carry forward. The balance. Out of 45, 20 is already set off. 25,000 we can carry forward. We can carry forward for the year 3. Year 3 we have a profit of 19. Against the 19, 25,000. So we can set off again 19,000.
Yeah.
So now altogether we have set off 20 plus 19, 39,000. We carried back and got 20, carried forward and got a 19, 39, 6,000 more. So when it comes for the 4th year, 25 minus 6 is your taxable profit.
Okay.
So that's how you do it all the time. Whenever the examiner says you can carry back and carry forward, first carry back, after setting off, go forward.
Yeah.
Okay.
Makes sense.
So that's the way, yes. Actually, it makes very sense. Only thing is you have to be careful what the examiner says. I mean, this case, he says both carry forward and carry back is possible. Some questions he might say carry back is not possible, only carry forward. In that case, we can't go and set off here. We have to go forward.
Yeah.
So whatever, look at the question very carefully. In objective test, only way that a knowledgeable student can fail is when you don't read the question properly.
Okay.
Right. So let's move from there one. Now, one thing that what can happen is as any business can come to an end of trading. That means as at 31st December 2016, you might decide we are going to shut down. So at that point, if we have any losses, what is the situation? So let's look at that one. So if you decide that you are going to close the business as 31st March 2016, then surely there is no way for you to carry forward, isn't it? Because you don't have a 2017 and 18 profit to carry forward. So at that time, what will happen is you will allow the entity to carry back the loss against the profits of the previous and to generate a tax refund. Normally, as I said, the tax department never gives a tax refund. They will allow you to set off your profit and all that. But the moment the business is ceasing, the business is ending, after that, of course, there is no way that you can carry forward and all that kind of a thing. So at that point, they will say they will give a refund after setting off whatever. So in this is in UK, it is called terminal loss relief. So I want you to note down that term. Sometimes the question may not be a calculation. The question will be just what is terminal loss relief. Terminal loss relief is always at the end of a particular period when you are ceasing the business, when your business is coming to an end, the whatever that is there as irrecoverable or unrecovered losses, you can go back and claim it for 3 years. That's a UK law. So let's assume again that we have a company that they have made a, say they have made a, let's assume that they have made 2011. I'm again looking at some figures. 2011, they have made a profit of 100,000. 2012, they have made a profit of 50,000. 2013, they have made a loss of 60. And at this point, they have decided their business is going to stop it. Right? So at this point, already 2011-12 finalized, but now because it is stopping, you don't have carry forward. So on the under terminal loss, you can go back. First of all, you must go to the closest year. The 60,000, you can set off again the 2012 profit of 50.
Okay.
So there you can set off 50,000 against the 50,000, and there's another 10,000 which you can go back for the next year and claim it another 10,000.
Right.
So for example, if you have paid taxes in 2012, the tax department will refund the money. 2011, if they are paid on 100,000, they will charge it on 90 and refund it on the 10,000.
Okay.
So this is what we call terminal loss relief. So this is also one of the famous examiner's area. He might not give you a calculation. He might give you a simple calculation like this. But more importantly, it is to see that we know the term very well.
Okay.
So you remember we were discussing all this time about what we call the profit taxes, or what we call on your trading, whatever we have to pay the taxes. In addition to the trading, we make profit on capital gains. Capital gains is whenever you dispose of property, plant or equipment or anything which is of a non-current asset, between the purchase price and the selling price, if there is a difference, subject to certain adjustments, you have made a profit and you have to pay taxes, what we call capital gains taxes. So the tax base here is the asset. In the income tax, the tax base is the profit, but here the tax base is the asset. What was the value of the asset when you bought it? What is the value of the asset when you sold it? What is the difference? On that you have to pay taxes.
Okay.
So it's simply the proceeds from the sale less cost of the asset. So that's the very simple one, but there are little adjustments. We will talk about it. But there may be an allowance for inflation, but let's not get confused with that one for the moment. Let's assume bought asset in 2011. You bought asset in 2011 for 75,000. And you sold the asset in 2014. So in the simplest form, 700 minus 75 is your capital gain.
Mm-hmm.
And on that, the tax rate may be slightly different from the corporate tax. It may be less.
I can't hear you. Said it again.
The tax rate may be different from the corporate tax.
Mm-hmm.
Earlier I said that 25% is the corporate tax. Sometimes the capital gains, the examiner might say the tax rate is 15%. So on the 25,000, 15% you have to pay taxes.
Okay.
That is one simple thing. But sometimes it so happens when you buy it in 2011 for 75, before you sell it in 2014, you have done some improvements. You bought it for 75, but between 2011 and 14, maybe you have spent another 10,000 for improvements. So your cost is not 75, 75 plus 10, 85. Even though originally you bought it for 75, before you sold, you have spent some 10,000. So that is also part of your cost. So 75 plus 10, 85. When you sell it for 100, sometimes you may have to pay a broker of some 5,000 selling expenses. And finally, what you may get to your hand is not 100, 100 minus 5.
Okay.
95. So then the capital gain is between 85 and 95. It is only 10,000.
Yeah.
So on the 10,000, whatever the rate, you have to pay taxes. So in other words, first I just looked at without any expenses, all that same simple thing. Second one, what I said was a little bit of a complication. You have increased your asset value, the cost by incurring certain expenses. That must be added to your cost. When you sell it, but you have to incur certain expenses that must be deducted from your sale proceeds. Difference between those two is your sale capital gain. Right? So that's a very simple one. what we looked at. So normally what are available for deduction is the sale proceeds, whatever the sale expenses what we incur, then always the original cost of the asset what we bought 75,000 plus any improvements we have incurred, we can set it off.
Okay.
That's a general thing. But having said that one, now sometimes it may happen, I will work out a little bit of a numbers, that one, for you to get a better understanding that one here. So let's assume, now let's assume that you bought this for 75,000. But 2011 75,000 will not be the same as 2014. Why? There is inflation. Isn't it? Right? So let's assume that 75,000 what you bought, they say the inflation between these 2011 and 14 is 10%. 2011 and 14, because of the inflation, so the 75,000 figure, you have to increase it by 10%, what we call indexation allowance.
Okay.
So if it was 10,000, you will take that also. So let me take that one now. So 75 plus 10 is my original cost, but that I will increase it because of the obvious inflation. It is going to increase. Let's assume the indexation allowance is 10%. So it is 93,500. Let's assume you are selling it for 100 and you have to incur 5,000 selling expenses. 95. So after indexation, your cost is not 85, now it is 93.5. Your selling net price is 95. Capital gains is only 1,500.
Right.
Right?
So you don't inflate the current price?
Yeah, that's correct. That's correct. You make the adjustment to the original price to make it current price, because otherwise you're not comparing the oranges, apples with apples.
Okay, yeah.
For that purpose you do. So sometimes the examiner might give you an indexation allowance, and with the indexation allowance you may have to do it. So let's look at some another question with few numbers here. So here a company has bought asset on 1st of February 2010. They bought asset which was worth 20,000. That was the time when the asset was bought, and they sold it on 21/11/16 or 21/11/15, let's say. They sold it for 50,000. Sale price was 50,000. 2010 they bought it for 20 and they sold it for 50,000. And they say the indexation allowance during this period is 30%. 30%. And the capital gains are taxed in this country at the rate of 30% also. So sometimes these are the things that can mislead when they give the indexation allowance also 30, capital gains tax also 30%. You might get confused, but don't worry. What you have to do is 20,000 you must index it. 20,000 should go up by another 30%. So it should be correct. 26. Selling price is 50. Your capital gains will be
selling expenses for these ones.
No selling expenses, no purchasing expenses.
Okay.
Yeah.
Okay.
Your capital gains is 24,000.
Yeah.
And on that, the 30% tax is 7,200.
Yeah.
These are the type of questions they might put it up on the capital taxes. The famous, I mean, you will have 1 or 2 questions in this area. This is what you have to do it.
Okay.
Indexation will be calculated on all allowable costs from the date of purchase to the asset to the date of the sale. So in both these cases, they gave the indexation allowance for the whole period. We just marked up that one. That's all.
Okay.
This indexation will reduce the gain and will make it more equitable. Yeah, because you are trying to compare apples with apples rather than comparing 2010 figure with 2015 figure. You make it more current and then compare the selling price, and any difference is the capital gain.
Okay.
So just a little bit of a pro forma for capital gain, how you calculate sale proceeds. Right? So this is what I've said, the 100,000 is your sale proceeds.
Yeah.
Cost to sell is 5. So that is first part of it, 95,000 we put it up. So that is 95. Then original cost of the asset, let's assume it is 50. Original cost of the asset. And let's assume that they have spent 10,000 to buy the asset or to improve.
Yeah.
60. And any enhancement, they would have incurred more enhancement, another 5,000 during the period. Then we do the indexation allowance on this entire 65,000. Let's assume the indexation allowance is 10%. 6,500. So the total amount is 71,500. 95,000 is the proceeds. 95 minus 71,500 is your capital gain.
Yeah.
Chargeable gain is 95 minus 71,500, and on that, whatever the tax rate you will apply. So this is the way generally to calculate the capital gain.
Okay.
There are certain items very specifically exempted from capital gains. So for UK, for example, your private motor vehicle is exempted. So generally one motor vehicle is exempted. So if you sell a motor vehicle, that is not subject to capital gains. Some of the boats, some of the animals are exempted from capital gains. So qualifying corporate bonds, some companies when they issue bonds, those capital gains are exempted. So you have to look at certain things what the examiner says what is exempted. So if you have profits and if some other things are exempted, you must remove those exempted items and only calculate capital gains on what is liable for capital gains.
Right. Okay, so this is just them trying to catch you out. Okay.
Correct, yeah. Because sometimes
so you have to read the question.
You have to read the question because they might give you that the company has, bought this thing, sold this thing. Some of the bought items and some of the sold items will not be subject to capital gains. So you need to ignore those things and calculate the capital gains only on the liable items.
Yeah.
So certain disposals like gift to charities, gift to government or museums are exempted. So you have to carefully read the question and look at that one and do it. So let's hope when you're doing questions, we will come across some of those.
Okay.
Just like just like accounting profit, we can have capital losses also, right? Capital losses can arise because you bought asset for 80,000. After your indexation and all that, it is 88, but you have sold it for 75.
Okay.
So then you can have a capital loss. So just like that accounting profit, you can set off against the accounting losses. Capital profits can be capital losses can be generally set off against the capital profits. You can't normally set off against the normal accounting profits unless on very exceptional circumstances. So we can normally claim against the capital losses against the capital profit. Just same as like last time in the accounting profit, if you have a loss this year, say capital loss of 15,000, we can claim it against capital losses, capital profit of the next year, we can claim it, carry forward. And similarly, we can do it carry back. This year's capital losses, you can go back and claim it against the previous year's capital profit, carry back. In rare situations, it will be allowed to offset against the trading income in the current period. You remember our accounting profit we made and we showed a profit, and there may be a capital loss in the same period. Generally, it is not allowed, but under rare circumstances, the examiner might say it is allowed to set off against the current trading profit, because otherwise the trading profit and the capital profit are two different sources of profits. They are not supposed to be set off against each other. Right? So for example, you might, let's look at some numbers again here. If you are allowed to carry forward, it should be set off against the first available capital gain. Because you can't jump and go, you must set off against the next available capital gain. So I'm going to look at some numbers here again. Normally no limit. Accounting profit generally they say 3 years, but normally capital profit they might not put up a limit. So I'm going to put some numbers here. Here let's look at capital gains and losses, no accounting profit. Year 1 we have a capital gain of 3,000. Year 2 we have a capital loss of 4,000. Year 3 2,500. Year 4 3,000. So second year it's a loss. Second year loss. And what they say is, in this particular country, capital losses can be set off against the capital gains in the same tax year, but any unrelieved losses cannot be carried back. Unrelieved capital losses may be carried forward, set against the capital gains in future years. So we have been asked to calculate the capital taxes for this company year 1, 2, 3, 4. So what they say is you can't carry back. Unrelieved losses cannot be carried back. So year 1 we have 3,000, no problem. Year 2 0, we can't carry back. We can carry forward. So the 4,000 loss we can carry forward for the year 3, which are 2,500 set off, and 1,500. So the entire 2,500 will be set off. You don't need to pay any taxes, capital taxes, right? Next year, there's another 1,500 available. 3,000 is your profit. So 3,000 minus 1,500, 1,500, you will have to pay taxes. So again, you have to simply look at what the examiner is telling. If the examiner is told we can claim it carrying back, then we would have carried back the 3,000, 4,000 against the 3,000, and 0 here, 0 here, and maybe if you can carry forward that balance 1,000, I will carry forward here, 1,500. This year, it will be full 3,000. So depending on what the examiner says, we have to do that way, and that's the way for us to go forward. Actually, these are very simple questions, but you have to be very, very careful with what we say. This is what I told you, the group issues. That is where a parent and a subsidiary exist. Sometimes the parent company may have a profit, subsidiary company have a loss, and for that purpose, you can claim the profit and losses. So for that purpose, there's something called group tax relief and appropriation of profits. So let's look at that one in little detail. Let's look at the group tax relief. So generally certain countries, now Sri Lanka they don't provide it, but in UK they allow you a parent has a profit, subsidiary has a loss, they can set off. Even though they are two separate legal entities, the law allows them to set it off. So, some countries allow only losses of the resident companies to be set off, while others may allow non-resident company losses also to be set off. So, you are a UK company, parent company. You have a parent profit of 100,000. Maybe your subsidiary during this period has a loss of 20,000. So both are resident companies in UK. So 100,000 minus 20,000. Parent company need to pay taxes only on the 80,000.
Okay.
You might find there is another company, this UK parent company is having another subsidiary outside UK, and that also has made a loss of say 15,000. Now this will depend whether the non-resident companies losses can be claimed. If it cannot be claimed, then forget about this 15. You can't claim it. But if it can be claimed, this is a non-resident company. If it can be claimed, you can claim the 15. And again, you have to look at what the examiner is telling carefully and do whatever he is telling, and that must be the right way to go through that one.
Okay.
So these are simple ones. Generally, tax groups are different from accounting groups. There can be various restrictions on the set off. Remember, each entity will still produce their own accounts and will be taxed individually. So they will prepare their own separate accounts, but only for taxation purposes, they might allow parent to set off against the subsidiary or subsidiary to set off against the parent. Either way, it is possible.
Okay.
However, if they are part of the group for tax, so it may be enabled to transfer losses between group members to save tax. This is what the group tax relief is. Capital losses cannot be usually set off between the groups. Only the accounting losses can be set off. Capital loss of one parent cannot be set off against the subsidiary capital losses. It must be set off against the parent only or the subsidiary only.
Okay.
So group relief could be used to save tax purposes. Group relief may enable relief to gain earlier. UK entities can transfer ownership of asset at nil gain or loss. That is possible. If a parent has asset which is costing 100,000, they can transfer it to a subsidiary at 100,000. So then there is no profit in the parent. You don't need to pay any taxes because your cost is 100, you sold it for 100. That is permitted.
Yeah.
But for outsider you can't sell it at below the fair value. If you try to do that kind of a thing, it will be caught up as tax evasion. If you sell it, if you try to say that you sold it to me, complete outsider, with asset worth 200,000, saying cost is 100, I sold it for 100,000 to Kuma, that will not be accepted. Kuma is outside.
Okay.
But within the companies, they can do that one.
Okay.
Now we come to a very, very important area. This is a key area. This is all about the appropriation of profit. Now, when a company makes a profit of, let's assume the company has made a profit of 100,000, and after making the profit of 100,000, the company will have to pay company taxes, whatever the company taxes, and after taxes, so let's assume the profit is 100,000. Let's assume the company tax is 15%.
The what, sorry?
Company tax. The
I can't hear you.
company tax, on the corporate profit, they have made a profit of 100,000 and there's a tax of 15%.
Okay.
So after paying 15%, they have 85,000. what we call profit after tax available for as dividends to be given to the shareholders.
Okay.
Right? Now this is where you have to be very, very careful. So here they have 4 systems because now already the company is taxed. 100,000 they made a profit and they have already paid a 15,000 tax. Now the question is, when they pay that 85,000 to the shareholders, should they pay a tax again?
I don't think so. They shouldn't.
Yes, right. That's correct. But then certain countries, they tax it, and that is what we call twice taxation. The same profit is taxed twice. So there are 4 systems because as a result, dividend may get taxed twice.
So it gets taxed once it's being given to the shareholders.
That's correct. Once a company made a profit, the company's profit belongs to the shareholder, isn't it?
Mm-hmm.
So when the company has paid the taxes, as you rightly said, logically, again another tax should not be paid by the shareholders. But unfortunately, the tax authorities are so clever, so greedy. Yes, exactly. So greedy. So because of that, they will try to tax your profit twice. So there are 4 systems. We are going to learn 4 systems that can happen. So I just want you to note down. This slide is there for you. Don't worry. I want you to note down there are 4 systems, and this is a very famous examiner's question. Classical system, imputation system, partial imputation system, and split system. So let me discuss each system separately. First of all, let's talk about the classical system. In the classical system, they treat the company as a separate person. Okay, company, you made a profit of 100,000, pay 15,000 taxes. Shareholder, you are a separate person. You are nothing to do with the company, and therefore on the profit what you have got, you pay taxes again. So that's what we call the classical system. So for example, let's assume the company has made a profit of 100 and the company pays 15% taxes. Already they have paid 15% taxes, and now let's assume that this company is going to pay a dividend of 42,500. Out of that 85,000 profit after 100,000, 85,000 they had a profit, and they are going to pay 42,500 a net dividend. Now what is a net dividend? Whenever a company pays a dividend, the companies are required to deduct a dividend tax, and that can be any rate. Let's assume the dividend tax is how much we should take. Yeah, let's assume that the company pays a dividend tax. The company is paying a dividend of 42,500, and on that 42,500, when the company pays a 42,500 to you as a shareholder, that you are treated as a separate person from the company. So when you get that 42,500, you have to pay, let's assume the dividend tax is 20%. Right? So as I said, in the classical system, company is a separate person. Company had to pay 15,000 taxes. When you get that 42,500, you are a separate person. Yanni will have to pay another 20% taxes. So you have to pay 8,500 taxes. So if you look at from the company's point of view, Jenny is the shareholder of the company. So how much of taxes you all have paid together? 15 plus 85 Altogether, the company, because Jenny is the company, Jenny is the shareholder. Altogether, the company has paid 23,500.
Yeah.
So that is one way. This is what we call the classical system, where we are being paid, where we are being taxed twice. Now, another system, what they do is they are more generous. They are a little bit fair. They give what we call full imputation. So the company pays 15,000 taxes. It's all right. Company pays 15,000 taxes. The shareholder, when he gets 42,500, right? 42,500 is what he is getting as a dividend.
Yeah.
The corporate tax is 15%. Now you have to understand this question. Corporate tax is 15%. So this 42,500 is equivalent to 85%. The corporate tax.
Say that again.
Yeah.
I didn't get that.
Yes. Now the company, you remember the company made 100,000 profit. They paid 15% taxes.
Mm-hmm.
Right? So after that, whenever you pay a dividend, that you are paying that dividend of whatever the 42,500 or whatever the dividend what you are paying is exactly 85% of your profit. 100,000 of your profit, 15% you pay taxes, right?
Yeah.
So now,
but only half of that is being paid as dividend.
That's correct. That's correct. Half is paid. So you want to see in that half, what is your total profit? 42,500 is equivalent to 85%.
Okay.
42,500 is equivalent to 85%. So I want to see what is my 100. What is my 100 going to be? Right? So 42,500 is equivalent to 85%. I want to see what is my 100 is. What is my 100?
Is it 53? I don't know.
No, 42,500 divided by 85 times 100, isn't it?
Okay.
Yeah, my 42,500 is equivalent to 85% of the profit. So what is my 100? So in other words, as you rightly said, they are paying half the dividend, right, out of the half. So that half is equivalent to 50,000.
50,000. Yeah.
50,000. So on the 50,000, right, so that is the actually the dividend, the total dividend. If there were no taxes, it would have been 50,000. Right? On the 50,000, I will pay 20% taxes. On the 50,000. Okay. Dividend tax is 20%. I will pay 20% taxes. So I will have to pay 10,000 taxes. Okay?
Yeah.
But I will get credit because the company has paid on my 50,000 15% taxes.
Yeah.
7,500, I can claim it. I can claim it. Yes.
How did you get that 7,500?
Yeah, because you remember the gross dividend was 50. Because the company has already paid, when they paid that 15% taxes, that 15% tax is paid on my behalf.
Okay, I got it. It's okay.
Right.
Yep, I'm following you.
So because of that, excellent. So because of that 7,500, I can get it as a credit. Earlier, I never got any credit, but now in this system, I get a credit of 7,500. So even though I have to pay 10,000, I will not pay 10,000. I will claim that credit of 7,500 and I have to pay only another 2,500.
Okay.
Correct? So the total taxes the company and I will pay is how much? Company has already paid 50,000 and company will pay, I will have to pay 2,500. Now you can see the total taxes you and the company will pay will be only 17,500. And the classical system, we paid 23,500 because nothing was allowed for me. Correct?
Right.
Nothing was allowed for me. But in this case, I'm allowed to claim the full imputation. This is what we call full imputation. The entire 15% what I paid, I can claim.
Okay.
Now the next scenario is where they say, no, they will not allow the full imputation. They will allow you a 10% credit. They are not going to give you the entire 15%. They will give you only 10% credit.
Okay.
So in that case, when you pay that 42,500 divided by 85 into 100, my total amount is 50,000. Same thing. But I can't claim the entire 15%. I can only claim 10%, partial tax imputation.
Yeah.
Partial tax imputation. So even though I have to pay 10,000, I will not pay the 10,000. I will pay only 5,000.
Yeah.
5,000. So my total taxes will be 15 plus 5,000.
Yeah.
So this is the third method, what we call partial imputation system. Split system, it can be a kind of a thing. They will say, okay, 15% is the rate for this one. As far as the tax, the 42,500 you got, you have to pay 10% taxes or something like that. That's what we call a split system. But the three important systems are the classical system, where no credit is given for you. You are treated as a separate entity and again you have to pay taxes. In the imputation system, what is happening is, whatever that 15,000 you have paid is given full credit for you. Partial imputation system, a partial credit is given, not the entire amount. A partial credit is given, maybe 10%, maybe 15%, whatever, they will give you a credit.
Okay.
So, very unlikely they will put up a question on this area on the calculations, but you must know the four systems. One is where shareholder is treated as independent from the entity and dividend is taxed twice. The other one is where the shareholder is given full credit for what the company has paid on his behalf. Third one is which is called a partial imputation system. Fourth one, here distinctions between the distributed profit and retained profit, and lower rate of corporate tax is charged on the distributed profits to avoid the double taxation. So distributed profit is 42,500 and the balance what is retained is another 42,500. So they will charge on the retained a lower tax and what is distributed another tax.
Okay.
So remember the four systems.
If our tax rate was, and if the tax rate was 20%,
yeah,
when we divide the dividend, it would be by 90, correct?
Yes.
Times 100.
That's right. Yes, definitely.
No, if you know what I mean. Yeah. Okay. Yeah.
Yeah.
I think I messed it up, but you get what I'm coming from. Okay.
Yeah, it's all right. You just have to take the whatever what he's telling and take it up.
Okay.
Very rarely we will have a question, but anyway, let us be ready for a question. We will look at some more numbers later on, but the four systems need to be known very well.
Okay. Yes, I will be doing some revision this week.
Yeah. So generally, we have a problem. I think I can't remember that we discussed this one. Generally, whenever a company pays interest is a tax deductible expenditure. Interest is always for the company, less like salaries, just like water, just like electricity. Company paying interest, it's a tax deductible expenditure. But dividends is not tax deductible. Dividend is paid out of profit. So if it has a parent and a subsidiary, now parent can give a loan to the subsidiary, and if the parent gives a loan to the subsidiary, let's assume subsidiary has to pay 10% interest, that is on the loan of 100,000, they will have to pay 10% interest 10,000, and if the subsidiary tax rate is say 25%, they can claim 25% of 10,000 as an expenditure, because that's an allowable expenditure. Whatever the interest you pay, you can claim it as a expenditure and it is allowed 25%. Okay.
Okay.
Right. Now, most of the companies, if in this case the parent will always, now okay, that's one scenario. The other scenario is parent doesn't give a loan, parent puts money on equity in subsidiary. And if subsidiary pays a 10,000 dividend, nothing can be claimed as a deductible expenditure because dividends are not allowed for taxation purposes. So here the subsidiary, the full cost is 10,000. Here for the subsidiary, the cost is 7,500. They can claim 2,500. So because of that, any parent subsidiary relationship, all the parent will like to give it as a loan and not as a equity.
Okay.
Not as a equity, because the parent can, the subsidiary can claim all the interest as a allowable expenditure. But you and I know a company has something called gearing. What is gearing? Gearing is the maximum amount generally a company can go as for borrowing. So this company is the parent company. This is the subsidiary company. Now, if the parent was not given the loan, say imagine if they are gone to a bank, the banker will not give them 100,000 loan. Banker will look at and say, no, we can give you a loan only 40,000. Right? We can give you a loan 40,000. But because the parent is a parent gave a loan of 100,000. But if it was a bank will give only 40,000. So on the 40,000, 10% is 4,000 interest. They can claim 25%, 1,000. Now look at scenario A and scenario B. When that subsidiary goes and gets a loan from a bank, they can get maximum 40,000. And they can only claim 1,000 as interest tax deduction. But when they borrowed from the parent, they are going to claim 2,500. Now this is also considered a kind of a tax abuse by the people, because they try to get more than the normally what is allowed. If they borrow it from the bank, they can only borrow up to 40,000 and they can only claim 1,000. But because they are borrowing from their own company, they are going to put up 100,000 and pay 10,000 interest and claim 2,500. Now this is not allowed by tax authorities. This is what we call thin capitalization. Again, not really a lot of questions. What is going to happen here is basically the parent is, instead of giving as equity capital, parent is going to give little equity, thin capital and more loans. Reason? By giving loans, parent can, subsidiary can claim all tax relief. So it's a thin.
So it makes sense.
Yeah, it makes sense. But the tax authorities know why do you want to do that one. So tax authorities will come and say, no, this is not fair, right? Because if you are outside company, you can only get 40,000. So up to 40,000, we will allow it. Balance thing, we will disallow it. So even though the parent has given 100,000 loan, you can't claim on the entire 100,000. They will say you can claim 1,000, balance 1,500, we are going to disallow it. Understand?
Right. And this is called thin capitalization. That's what that's called.
That's called thin capitalization. That is, in other words, thin share capital. Thin share capital. Big loans. Lot of companies were doing this thing for a particular purpose to save taxes. But the tax authorities have come very hard on this one, and now they have something called thin capitalization. UK, they allow only 50% is the amount of the loans they allow. The balance, they say, no, that's not capital, that's not loans, it has to be capital. So that's what they do it. So this is what we call recharacterizing debt. Even though it is a debt, it is treated as capital equity for all purposes.
Okay.
Now we have almost finished up with our direct taxes. Now we are coming to indirect taxes. So what are these so-called indirect taxes? Indirect taxes, as the name suggests, it is not put on the income tax. Anything that is based on profit is what we call direct taxes. Anything that is not on profit, other than profit as the base, expenditure, property, wealth, consumption, all those things we call it indirect taxes. Anything that is not of profit tax, not based on profit tax, is what we call indirect taxes. So indirect taxes, there are many indirect taxes that they have put it up. Number one is what we call unit taxes. So it is not based on your profit, it is based on the number of weights or items. So certain things when you import, now say for example, when you are going out of the country, you have to pay excess baggage, right? It is based on the weight. You have to pay taxes based on the weight of items. So when you are importing certain things based on, not on the value, not on the profit, it's based on the weight of items or the number of units that you bring. So one of the best examples is what we call excise duties on alcohol and all that kind of thing. It is based on, not on the value, it is based on the liters or whatever.
Okay.
Then we have the what we call ad valorem taxes, that is based on sales value. So again, not the profit, but it is the sales value. When the restaurant, when you go and buy and eat, it is whether the restaurant has made a profit or not, they have to pay on the sales value. So you are not given credit for the cost of sales, you have to pay on the sales value, and that is what we call the ad valorem taxes.
Okay.
Then we have excise duties, again not based on the profit, it is simply based on the value. So maybe some consumption, maybe the import of vehicles, all that kind of thing. Generally we have to pay something called excise duties. Mostly it is for the purpose of discouraging consumption, like alcohol, like cigarettes. You try to put up a tax based not on the profit, but based on the value of the amounts what they sell.
Okay.
Then we have property taxes, again not based on the value, not based on the profit, but based on the capital value. So last year Sri Lanka, there was a very controversial tax that our finance minister tried to introduce. He said all so-called mansions and properties you have to pay a huge tax. And most of the people who are living on these mansions and properties, the big bungalows, are really not the rich people, but they have inherited their properties from their grandfather, the great grandfather. In fact, it's a burden to maintain those properties, but they leave it for the sake because of sentimental values and all that. So our finance minister thought they are very valuable properties and they must be taxed. And there was such a big controversy because people who were living on those were very old people. They simply could not pay any taxes. They would have had to sell that mansion to pay the taxes. So I also got involved in that one, and then later on that tax was withdrawn. So that is what was called the mansion tax by our prime finance minister. So property taxes, most of the properties, urban properties, you have to pay high taxes. Rural properties, you have to pay low taxes, or that kind of a thing. That is also something which we have to look at. Wealth taxes. So certain countries, I'm not sure UK whether they have it now. Basically, based on the wealth of the particular person, they have to pay taxes. Sri Lanka, we had it, but no longer it is not there. Consumption taxes. That is basically things like the value-added tax what we pay, which we have to pay on the usage, on the consumption, whatever we pay taxes is what we call the consumption taxes. So these are all types of indirect taxes. So you maybe put up a question, put in a many taxes and asking you to list out the indirect taxes. So unit tax, ad valorem tax, exercise duties, property, wealth, consumption, all are indirect taxes. Coming back to the consumption taxes, there are certain taxes what we call single state tax. USA is a particular country where you have to pay taxes on consumption, 1 point, and that's all. So for example, you may be producing a product and you are selling it to me for $10,000. You are A. You are selling it to me for $10,000. I buy it from you. I sell it for 12,000. Another party, you are the wholesaler. I'm the retailer. I sell it for 12,000. But the single state tax you have to pay only once. So maybe at the time you are selling, you have to pay 1,000. And that's it. I don't need to pay any taxes because at the point of manufacture, when you sold it, you pay the taxes, and that's what we call a single stage consumption tax. Then we have the pardon?
No, I just said, okay,
Right,
sorry,
okay.
continue.
Right. Then we have the multi-state tax, which we call simply the value-added tax. When you sold it to me, you have to pay 10% 1,000. When I sell it at 12,000, I had to pay another 1,200. So this is what we call a cascading tax. It is being paid at every point. You paid on the 10,000, and I sold it for 12,000, and I also had to pay 1,200, and this is what we call cascading tax. Crazy tax, in a way. Everyone in the chain will have to pay taxes. But this got little bit refined with the value added. What they said was, no, this is not, there are some taxes like this. At each point, you have to pay taxes. You can't get any credit. But the value added tax came and settled this to a great extent. When you pay 10,000 and when I pay on the 12,000, I can claim that 1,000 rupees because you recovered from me 1,000. Right? When you sold it for 10,000, real selling price was 1,000, 9,000. You got another 1,000 from me for taxes. So when I pay the 1,200, I can claim whatever you have paid. I had to pay 1,200 what I call output tax. But you claim, because when you sold it for me, you get 1,000 and I can claim that one and I had to pay a net of 200. This is what we call value added tax. On my value addition only I had to pay. But I bought for 10,000. I told you. Pardon? Yeah.
It's basically the VAT return, yeah.
Yeah, on the value added. On the 2,000 only I had to pay. So this is the modern taxation system. Most of the people use this one. And this is more equitable, I suppose, because whatever that you paid, but finally, ultimate consumer has to pay the whole tax. Whatever you paid, you will claim it from your supplies. I will claim it from my supplies. But when you sold it to me for 12,000, ultimately I have paid the taxes of 1,200.
Yeah.
That is what is happening. So that's simply a consumption tax, and this is what is really happening with the value added tax nowadays. So it can be a single state tax. Can be a multi-state tax. So when a multi-state tax, there are two types of tax. One we call the cascade tax, where at each stage it is taxed. Then of course the other one is on the value added we pay. You whatever the taxes you pay at each stage, you can claim it and you can go on doing that one. So cascade tax is taxed at each business cost because no refunds are allowed. You pay, I pay, everyone pays it. But VAT, whatever you pay, I can claim it. That is the modern tax is charged at a time component of product is sold. Every time whoever who sells will have to pay that output tax, whatever the rate. So you can recover it from your ultimate customer and you have to pay. But whatever you have paid in arriving at that one for your raw material inputs, you can claim it as an input tax, and the difference is what you pay. Output minus input is what you pay. So ultimately the tax burden entirely goes to the consumer, because the business people can claim whatever the taxes they have paid. They only have to pay on the value added. Output tax is VAT charged to the consumer. So you go to a restaurant, have a good dinner, they will charge a VAT, and that is the VAT charged to the consumer. And the restaurant owner, when he bought the vegetables and all that, he would have paid the taxes. He can set off whatever the taxes he has paid to the vegetable supplier from your taxes, and he pays only the net amount. Input tax, VAT on the purchases, you can claim it. So basically, VAT is charged on items what we call taxable supplies. So taxable supplies are defined in the act, in the law, saying these are what we call taxable supplies. Certain items are exempted, certain items are taxed at a different rate. So taxable supplies could be taxed at standard rate. So most of the restaurants, all that, there's 17.5%, which is a standard rate, which we have to pay. But then there are certain things taxed at a higher rate. Luxury products, what they call it, they can tax it at a higher rate, like motor vehicles, 22.5%, 25%, that kind of a thing. So normally you can have a standard rate, you can have a higher rate. Then you can have a what we call a zero rate. Zero rate means you don't have to pay taxes, but if it is zero rate, although on your output you don't pay, whatever you have paid on input, you can claim it. If it is zero rate. But if it is exempt, you don't pay, and then in that case, the input what you paid also, you can't claim it. Now that you have to be very clear. Here, nothing can be claimed, because since your product is exempted, you can't claim any taxes what you have paid. Zero rate, you can, even though you don't need to pay taxes, whatever the input taxes you have paid, you can claim it. Higher rate, you can claim all your input tax. Standard rate, you can claim all your input tax. So if it is exempt, even though people think it's a good thing to be exempted, I think it's not good, because when you're exempted, you sell it, you don't have to pay to the customer. The customer don't need to pay taxes, but whatever taxes you have paid, it is a cost for you. Let's assume that you have bought a product for 100,000 and you paid a tax of, let's assume, 15%. Now this has become 115 is the ultimate amount you pay, and now you do certain value additions and you sell it for 125,000 something. Let's assume it is water, and the government says what is tax exempted, VAT exempted. So because of that, you can't charge VAT to your customer. You sell it for 125,000. And when you sell it for 125,000, you can't claim this 15,000. So you sell it for 125. This 15 you can't claim it. It becomes a cost for you. So your profit will be only 10,000. Imagine this was zero rated. Imagine this was zero rated. What is zero rated? Then you don't need to pay taxes.
But you can claim what you've paid.
You only have to charge 100,000.
Mm.
You can claim 50,000 from the tax authorities as a refund. So that's the difference, because I was in the water sector. The people think when water is exempted, it's a good thing. I had to go and fight with the government and say, no, don't exempt me. You charge me zero rate. Because when they charge zero rate, all what I pay on my electricity, all what I pay for my supplies, chemicals and all that, the VAT I can claim as a refund. So my cost is only 100,000. So these are few things that you need to know about the VAT taxation. VAT rules, you have to be very careful. There again, the examiner can put you into a little bit of a soap. Examiner might say that you have sold the product and the total amount you have collected was 112,500. Including VAT of 12.5%. So this 112,500 is equivalent to 112.5. So we can find out from that one what is the VAT you have collected, including, if it is including. So 112,500 is equivalent to 112.5. So the 12.5 is equal to 12,500.
I can't really hear you. Can you say that again?
112,500 including the VAT of 12.5, the examiner might say.
Okay.
Right? So in that case, 112.5 divided by 112.5 times 12.5 will be the VAT what you have paid.
Yeah.
Including the VAT. Sometimes the examiner might say you sold it for 112,500 excluding VAT. Excluding VAT. In that case, you have to add the 12.5% as VAT, excluding VAT.
Yeah.
So, if they say 112,500 excluding VAT, then to get your VAT, it should be multiplied by 12.5% to find the VAT figure. If they say including VAT, then you have to divide it by 112.5 times 12.5 to find out the VAT. So just see what the examiner is telling, whether he is telling exclusive of VAT or inclusive. If it is exclusive, the price 112,500. into the tax rate is the VAT. It's inclusive 12,500 times tax rate 12.5 divided by 100 plus tax rate 112.5. So you have to carefully look at, so we will look at some numbers in our next lesson. You have to carefully look at what the examiner is telling, that these are the only things you have to learn. Tax rate, tax questions are very easy, but you have to very carefully see what he's asking, and we will look at some numbers.
Okay.
So but there are few administrative things. There are one or two questions that can come up. Whenever you are liable for VAT, that is after a certain amount of business, a certain amount, the minimum little amounts they don't bother. But if you reach a particular figure for a particular quarter, then you must register yourself for VAT. He can be an individual, he can be a company. The supplies, that is whatever you buy, it can be either zero or standard rate. So some things you don't need to pay taxes, some things you have to pay taxes. Then when you reach that particular limit, the examiner might tell you quarterly limit is 150,000 pounds, and if it is the case, after that you must register yourself with HMRC for purposes. And when you are registered, you must issue VAT invoices. Always the VAT invoice must show VAT separately. If the selling price is 100, VAT is 12.5, 100 is the price, 12.5% VAT, then show the total amount as 112.5. Because when you collect 112.5, 100 is your sales price, 12.5% is the amount you have to pay to HMRC. Keep all the records properly because they will come and check it. Charge VAT tax on taxable supplies to customers. So whenever you are selling, you must charge the VAT. You can claim your input VAT on whatever the things what you have bought. Difference, you must pay it to the HMRC, maybe quarterly, maybe monthly, depending on what they are required. Then we come to a final section called employee taxation. You and I, when we work in a company, when we do our employment, we have to pay taxes based on our remuneration. But actually, the burden is not on us. The burden is on the employer to deduct the right taxes and send that taxes to the HMRC on behalf of us. And that is what we call pay as you earn. So, for pay as you earn, your remuneration is definitely included, and also there are certain other benefits, the bonus, commission, all that. Then there are certain other non-cash benefits. They will value it, the company car, living accommodation, any loans given at subsidized rate, all that will have to be paid. Certain deductions are allowed for business travel, that kind of thing for the employee, but very rarely the things are allowed. Most of the things are not allowed because whatever the salary we get, we are supposed to pay the taxes. Most governments use pay tax to scheme employees. The benefit of the pay scheme, this is a famous question they ask. Very little default of minimization, minimization of defaulting, because the employer pays the tax, not the employee. Very easy for the government to collect the money. You don't need to go and ask 100,000 employees. One employer, they collect all the money. Very predictable cash flow because they know this employer is paying 1 million salaries and they will collect 250,000 taxes, send it to the government. And the administratively very easy to deal. You don't need to deal with 1 million employees. You need to deal with only 10,000 employers.
Yeah.
Then we come to something called international taxation. Now that is all about the when your company is doing business outside your company, outside your country, sometimes you have to pay taxes in both those countries. So you are a UK company. In UK, definitely you have to pay taxes. But if you are having a company in Malaysia, sometimes the Malaysian government also will tax you. And then when the balance profit comes to UK, UK also will tax you. So again, like the dividend, it will be taxed twice. So to avoid that kind of thing, most of the countries have what they call double taxation treaties or double taxation agreements. So sometimes through the agreement, through the understanding, the UK government and the Malaysian government might agree. You don't need to pay taxes in both the countries. You pay in Malaysia, that's it. Or Malaysia will say, no, they don't need to pay in Malaysia. Then you have to pay it only in UK. Or sometimes whatever you pay it in Malaysia, you can claim it as a credit against the taxes you have to pay it in UK. So there are many ways. Again, the examiner will give you the way to do it, and looking at the way, we may have to work out the taxes. The main idea is the countries, they have understanding, they don't want you to pay taxes twice. So that is what we call double taxation relief. In our SEMA taxation, we have not been tested at very heavy levels, but we need to know all the principles of taxation. So there are three methods. One is to exempt. You have a UK company, you have another USA company, but you are operating from UK. The USA and UK, they have agreement, and if you have paid taxes in USA, you don't need to pay taxes again in UK. So partially they can exempt, fully they can exempt it, whatever the way they can do it. Tax credit. Okay, you are a UK company. In USA, you have paid some taxes that you can claim it as a relief or as a credit when they compute the taxes again in your country. Whatever that is paid in USA can be set off, only the difference need to be paid here. Deduction, that is basically whatever the taxes you have paid there, it's not a credit, it can be deducted straight away and pay only the net amount here. So three methods: total exemption, partial exemption, tax credit, or deduction.
Okay.
Overseas operations, as you know, we can either have a branch or a subsidiary. Most of the banks, they have their branches. Some companies, they have their subsidiaries. So subsidiary is basically a separate entity, and it will be subject to separate taxation. So if you have a subsidiary in USA, it's a separate entity and it will be subject to USA tax laws. If it's a UK company having a USA branch, then since it's not a separate entity, it will be taxed only in UK because it's a part of UK's operation, but it's a branch in another country. So overseas branch is treated as an extension of the domestic activity, and branch profits are subject to domestic taxation and loss relief is available because it's part of your UK profits. It's so you can claim it even if there's a really loss, you can claim it. Foreign tax types. Again, we can have withholding tax. When a foreign country do operations, they will tell you have to give 20% of the profit as a withholding tax. There can be something called underlying tax. So that also we will look at some numbers again. When an entity pays a dividend, when a foreign entity pays a dividend, just like in that imputation system, they will give you a part of credit for the corporate taxes they have paid there. So underlying tax is tax on profit times gross dividends divided by profit after tax. So I will work out a number with you on that one. different countries will give you different reliefs, but we are not supposed to know all the calculations and all that. We need to know different types of taxes that can happen, and that should be all right. There is a model what is called OECD model of tax convention, because just to avoid various countries interpreting and various countries being unfair on taxation, there is a model which says taxes should be done only in the permanent country. So that is basically to address the double taxation. Basically it says enterprise should be taxed only in one state, one country, if it has a permanent establishment. So the problem is, what is a permanent establishment? Now you can have your registered office in UK, but you might have your board meetings, everything in USA. This happened in the International Cricket Council. They operated from UK and they had to pay huge taxes. So what they did was they took their office, they had their company registered in UK, but they went and had an office in Dubai, because in Dubai it's tax free. So they said our permanent establishment is in Dubai, we are meeting there, and therefore we don't need to pay taxes. And that was accepted, because even though registered office is here, basically the transactions are done, the board meeting. So they try to establish where the permanent establishment is. So permanent establishment rules are factory. If you have a factory in a particular country, it's a permanent establishment. A workshop. If you have a workshop where people are working, that's a permanent establishment. Office, it's a permanent establishment. Now INSEAD, for example, they have office in UK, and therefore they are subject to UK taxes now because they have a permanent office. I'm not subject to UK taxes because I don't have office in UK. I operate from Sri Lanka.
Yeah.
The place of management, where do they have their board meetings, etc. Right? Particularly in the oil exploration, if they have a mine or an oil well or something, that's a permanent establishment. Project, a construction or a building that is going to last more than 12 months, that is your permanent establishment. So there are certain laws, certain rules that will decide very easily the permanent establishment. So where the entity is having a kind of a residence in several countries, the model suggests that the entity is resident in the country of effective management. So sometimes you might have a factory in one country, workshop in another country, office in another country, and the question is, which country is the permanent establishment? So they say effective management. Effective management is, where do you have your board meetings? That's your permanent place.
Are we finishing now? It's been the time when I have to go.
Okay, right. I think it's the last slide. Just give me a minute, I think.
Okay.
This is all about transfer pricing. So particularly the multinational companies, what they have is, sometimes they can, if they know that one country tax rate is low and the other country tax rate is high, they can transfer raw materials at different prices to get the advantage of transfer pricing. So this is a tax avoidance scheme which was considered perfectly legal, because the companies can decide the transfer pricing to do it. But now this is not allowed, because the rules are there. They will try to see if a company is misusing this one, they will try to disallow this expenditure. So I think that we are almost at the end of the taxation. I will look at this one, the administration and all that we can just look at. And when we meet, when are we meeting again?
Sunday.
Yeah, Sunday when we meet, we will look at this one, and I will send you a few questions. We will look at some questions and then we move into the other area.
Okay.
Okay, so let's meet on Sunday. and Sunday we are meeting in the morning, no?
Yeah.
Yeah. Right. Okay. Let's work it out on Sunday next. Okay then. I'll see you on a Sunday.
Okay. Thank you very much. Have a good rest of the week.
Thank you. Take care. Same to you. All the best.
Bye.
Bye.
Thank you.
Bye.